Today's couple, Tom and Rachel, are both 60 years old. They make good money. They have $2 million saved, and they've run every online calculator you can imagine. Every simulation says they're good. Retire now? Check. Travel the world? Check. But here's the thing. There's a secret risk hiding inside their plan. A risk that doesn't show up on those fancy calculators, and it could derail everything that they've worked for. We're going to find it, fix it, and see if Tom and Rachel's dream of retiring now and traveling the world actually holds up. This is the Retirement Challenge Episode 2, and it starts right now. Let's dive into the scenario. Tom is a regional sales rep. Rachel's a nurse practitioner. They're both 60 years old, and they've been diligent about saving for years. They had both been planning to retire at 65, and they were on track for their goal of a $3 million portfolio at that point. They knew that it'd be enough to meet their lifelong bucket list item of seeing the world, and they thought they had it all figured out. And then Tom's college roommate passed away. He was only 60 as well. It was very unexpected, and it gave him a jolt, a wake-up call. Despite having a great plan, despite doing all the right things, they realized that nothing is promised, and that prompted them to start looking into whether they could retire right now. Did they have enough to start living that dream retirement today, just in case they didn't end up with as long as they planned? In talking with them, and by the way, as always, Tom and Rachel are based on a real-life client situation, but I've changed things up enough to be able to share stuff with you here without telling anybody's business on the internet. So in talking with them, let's talk about what they wanted from their retirement. They wanted $10,000 a month in income to pay their day-to-day bills. That was what they needed to kind of keep the train on the tracks. So we booked that in as their first goal. We'll trend it down about 15 years into retirement as they reach slow-go territory. Remember, the retirement spending smile. Retirement is not equal all throughout retirement. And then they've got their big travel goal. They want to see the world. They've got a huge bucket list, and we've boiled it down to about $25,000 a year after taxes every year for the next 10 years. We've also included a healthcare goal because, especially if they retire today at 60, we've got some serious costs to cover. And finally, it's important to Rachel to leave some money behind to their kids, Tommy and Erica, someday in the future when they pass on. Her parents left something behind for her, and to her that feels important, and so we've got it listed as a goal as well. Now, we're going to list that down on the end of the goals, if you see there, because they both agree that while they want to leave some money, they want to live their retirement. They don't want to shortchange themselves just to make sure there is something left over when they're gone. Now let's get into the numbers. They both earn about $125,000 a year. They've been disciplined savers. They're saving heavily into their 401ks, a fund specifically for travel, and they've got a brokerage account with after-tax money where Tom's been buying some stocks. Here's what the snapshot looks like. The 401ks have about $1.3 million between them. They've got $350,000 in that brokerage account. Again, mainly individual stocks, a lot of technology stocks there. And then they've got a travel fund with $140,000. That's in a high yield savings. They didn't want to risk that in the market. And so they said, hey, we'll put that over in the savings account so that it's there. Rachel's got a Roth IRA with $100,000, also very heavy in a stock allocation. And then they've got an HSA they've been building up for years with $80,000 in it. They've saved receipts so they can use that money in retirement for a host of different things. And finally, $30,000 in the bank. That's their emergency fund. Their home is their other big asset. It's paid off. It's worth about $800,000 today. And so that leaves them with about $2 million in an investment portfolio. That's a really strong portfolio. And when you include the house, they're up to about $2.8 million of assets, and they're totally debt-free. On paper, this is a great plan. Lots of savings, no debt, clear goals. Now let's take a look at something that stuck out to me when we started reviewing with them. They have what I like to call polarized money. You see, while you're working, basically you need money for two things. You need money for the future, for someday far off when you retire, and you need some cash now in case of emergencies, in case something happens. And so if you live below your paycheck, you put away money for the future, and you keep a little bit of money in cash during your working years, you're basically good. The problem is that as you near retirement, really within 5 or so years of retirement, you have to start moving money into different places to prepare it for the new jobs it's going to have. See, when you retire, it's not just future money anymore. You still need money for the future because retirement is a 30+ year journey, but you need money to create an income, a retirement paycheck, not just future growth at that point. When we plot out their money, something jumps out immediately. About $250,000 in cash type of accounts, that travel fund, the HSA, the bank savings, everything else. About $1.8 million is roughly 90% in stocks. That's very polarized. That's a lot of growth money for the future, and then some cash down on the other end. They've been riding the hot market, especially what's been going on with tech, and it's rewarded them so far. But that strategy only works until it doesn't. This was a huge red flag to me, but we'll come back to that in a minute. First, let's look at what their plan actually says. So when Tom and Rachel ran their own online calculators, when they were out looking at websites and trying to do some planning to see if they were there, everything came back well. I'll even show you here, when we test their scenario, comes back with an 83% success rate. That tells us this plan is very doable, and honestly, that makes a lot of sense. They got $2 million. They've got reasonable spending goals. They got pretty sizable Social Security checks to come in the future. On paper, looks pretty rock solid. And they came to me thinking, we just need a double check. We just want to make sure we didn't miss something. But here's the thing. Those calculators assume average returns. They don't assume real life timing. And so I asked them, what if the market doesn't cooperate? What could go wrong? And let's look at that right now. Now, this is that thing I was talking about earlier. Their current portfolio, stress tested through a 2008 type of market, shows that they'd have lost 39%. That's almost $800,000. And if potentially living through a loss like that isn't bad enough, let's look at what that actually means for their plan, what it would mean for their retirement. And so if we rerun their plan using a 2008 style recession, a 39% drop in their balances at retirement, you can see the success rate falls to the floor, falls from the 80s down to 35%. That's not a small dip. That's the difference between sleeping well at night and lying awake wondering what you've done and what kind of mistake you've made and how you can fix it. This is an absolutely crushing retirement loss, and it's not some doomsday scare tactic. They are way too aggressively invested to be this close to retirement. And let me tell you, they're not alone. This is something I see a lot of anymore, almost weekly. I'll talk to somebody who's invested this way, and I'll talk more about that in a second. But first, let's explain what's actually happening here, what that secret risk is that's breaking their retirement. What we're seeing is called sequence of returns risk. It's the danger that bad markets hit early in your retirement when you're just starting to draw income and you have the most money at risk. If the market drops early and you're retired, you still need income. You still need money to pay the bills. Nobody cares that the market dropped. That often leads to selling shares at a lower price, sometimes at a loss, to fund your living expenses, which means you own fewer shares when the market eventually recovers. Even if the average return ends up the same, you never get back to where you would have been because you were drawing from it as it was going down. Once that snowball starts rolling downhill, if you're drawing from the portfolio, it can be almost impossible for the market to earn you back out. That's why I always tell you guys that in retirement, it's not just what you make, but when you make it that matters. And this is a risk, as I said, that I see all the time right now because so many people are still invested like they have been for years in growth mode, not in income mode, and they conflate good returns with good investments. When the portfolio is rising, they assume everything is right, and they ignore the fact that their money shouldn't live like that anymore. It's what I call Wall Street roulette. You're giving control of your retirement to something that's outside of your control, to the stock market. This is exactly why we created the Clear Vision Retirement Plan, by the way, to help you build a retirement strategy that doesn't depend on luck. We help you structure your income, your investments, and a tax plan so that you can get a reliable paycheck for your retirement without gambling on market timing. If you want to see what it looks like in your own plan, I'll put a link down below. Go ahead and click it. You can set up a consultation and I'll walk you through it. Now, the good news here for Tom and Rachel is that they don't need a completely different plan. They just need a different structure. All the pieces are here for a successful retirement. We just have to protect them from some risks, including the big one that we're talking about right now. And so here's what it looks like. We restructured their portfolio into a 3-bucket plan. Bucket number one, cash and short-term income. We used a lot of that $250,000 in cash, travel money, and shifted it to cover near-term spending needs for the early years of their retirement. This creates a buffer against market volatility and buys us time for bucket number 2 and 3. Bucket number 2, those are your income producers. Going to be a lot of IRA money in this instance because they were IRA money heavy, but we're going to produce income from those sort of things, and we're looking to create that retirement paycheck to close their income gap, what they'll have coming in versus what they'll need coming in. This produces steady income to fuel those retirement goals. And then we've got bucket 3 money. This is their growth money. We can keep it invested for growth and inflation protection for the future, but now it has time to recover from any losses because buckets number 1 and 2 are going to cover us for income. So we've separated our growth money from our income money from our cash reserve in retirement. We've given different money different jobs. We also mapped out a Roth conversion strategy during some of those early years when they've got some income flexibility to lower their lifetime tax bill, and that helps with building a tax-free legacy for Tommy and Erica. When we rerun the simulation with the 3-bucket plan in place, you can see the success rate climbs back up, actually gets into the upper 80s on the Monte Carlo, even when we stress test for a recession. Tom and Rachel did almost everything right. They worked hard, they saved diligently, and they planned ahead. But they almost made the same mistake I see many near retirees make. Assuming a big portfolio means a secure plan. The truth is, sequence of returns and a whole bunch of other quiet risks can make or break your retirement success. And the solution isn't about predicting markets. It's about structuring your money so that you don't have to. Even if you saved millions, you still need a plan that tests what could go wrong, not just what you hope will go right. If you're wondering how something like this affects you, let's find out together. Click the link below and set up a time to talk about the Clear Vision retirement plan. And while you're at it, if you enjoyed this case study video, I got another good one for you. I'll put it right over here.